The sharp increase in inflation and subsequent rise in interest rates over the last 12 months has caused a recalibration of valuations across most financial markets globally. This has been felt particularly acutely within sectors such as property, due to the dual impact of higher yields on long-dated income streams and the higher cost of borrowing as debt reaches maturity. This backdrop is likely to accelerate the trends already underway within the property market. And today, we'll discuss the differing prospects of the various segments of the UK commercial property sector. Hello and welcome to the Investor Insights podcast, hosted by Killik Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on the topical issues of today. Killik Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan and invest. And you can find more details of the unique ways in which we do that on our website, killik.com. In this episode, we speak to Andrew Jones, Chief Executive Officer of LondonMetric Property, the London-listed real estate investment trust. Andrew has a huge amount of experience within property markets. He previously served on the main board of British Land before co-founding Metric Property in 2010. When this company merged with London Stamford in 2013, Andrew became Chief Executive of the enlarged business. The company has grown to become a £3.2 billion property portfolio and a constituent of the FTSE 250. The company's current portfolio has a heavy focus towards logistics and distribution assets. Online sales penetration has understandably fallen back from the peak seen during the pandemic. However, the Office of National Statistics calculates the percentage of internet sales as a proportion of total sales remains notably higher than the period prior to lockdowns. This trend is also expected to continue upwards, and it's anticipated that the level will increase from 26% currently to 30% over the next 2 years. Coupled with the constrained supply of logistics property and suitable land for development, particularly around major urban conurbations, this provides an attractive backdrop for owners of existing in-demand assets. This demand is reflected in high occupancy rates, long lease lengths, and strong income growth. And it's a combination of these factors, alongside the shares currently offering a well-covered starting yield of over 5%, which imply attractive long-term return prospects from current levels. This is a particularly interesting time to talk to Andrew, given the depressed valuations at which much of the London-listed real estate investment trust, or REIT sector, currently trades. This discussion was recorded after the company's public announcement regarding a possible merger with another London-listed REIT, LXI, but before any formal details of such a deal had been published. Andrew, thanks so much for sparing some time to talk to us today. How are you?
Good. Looking forward to the end of the week.
And so a question we've been asking just to start these discussions off is one which tries to get a bit of an insight into the kind of working week of an asset manager. And I wonder whether you can maybe share kind of any anecdotes from the last week or so, any kind of interesting company meetings or research trips, or even just a kind of book or article that you've read, just anything that kind of gives us a bit of an insight into your working life.
This has been a relatively busy period for us because we've been reporting on our half-year numbers. There's been a lot of shareholder engagement. And I break my week down into thinking I spend a third of my time with my shareholders and a third of my time with looking at new opportunities in the investment team, and then a third of my time looking at other opportunities with the asset management development team, and a bit of time with banking and whatever else. So this has been a bit more shareholder engagement over the last week or so, the last couple of weeks actually, which is good. I enjoy it. I get incredibly stimulating. No two meetings are ever the same, and people come at it very differently. It's the joys of being a listed company. In terms of readings, I do spend quite a lot of time reading. Those of you who don't know me, I'm a Warren Buffett, Charlie Munger disciple. Whenever I can read about them and value investing, I do that. So I've been listening to a podcast called Acquired over the last week, which is an interview actually that was recorded back in October with Charlie before he sadly passed at 99 and nearly at 99.9. years old. He was still incredibly lucid. He had a great innings. And so I enjoy listening to people like that.
Absolutely. Yeah, so let's dive into the LondonMetric portfolio. As you said, you fairly recently published those half-year results, but it has been a very significant kind of regime change across all financial assets, but not least of all, perhaps property, just given the kind of long-dated income nature of it. And your recent commentary has discussed in reasonable depth this kind of polarization between different parts of the property market. And you can absolutely see that kind of reflected in the LondonMetric portfolio, continuing to avoid pretty large segments of the commercial property market. I wondered perhaps if we start with the kind of the challenging side, can you talk us through those areas like office and retail, which you flagged? What are the kind of biggest challenges you're seeing there?
Look, I think that I've been in the real estate market now for 32, 33 years. My original roles were in shopping centres. I think I spent the first 10 years of my career buying, selling, asset managing and developing shopping malls. And I then moved into retail parks. And as you know, Gordon, we decided consumer behaviour was continuing to shift, which we believed would prove that warehouses were going to become more important and more integral to the supply chain. And we obviously pivoted into that 8 or 9 years ago. But I think that the powerful forces of technology and consumer behavior are, you cannot ignore them. The fact of the matter is, no matter how hard you work or how clever you are, the macro will always outdo the micro. The fact of the matter is, when the tide's going out in a particular sector, you're best getting out and swapping sectors than you are trying to fight it. A great Charlie Munger quote is, "It's the strong swimmers that drown." We think offices are being hit by technological induced changes to consumer behavior around work from home. We think they're being impacted more materially than other sectors on ESG and EPC issues, and workers' demands for higher and higher contentments and services and things. And so that comes with a cost, which isn't always reflected in an increase in revenue. So we think offices are difficult. The truth of the matter is, I've always thought offices were difficult. They now feel like now, when you're sitting as you and I are in the West End of London in pretty special buildings, really, then there's not much evidence of that. But we've got to remember that the UK has a very, very wide and very deep office sector. And you just have to look at Canary Wharf, you have to look at the city, you have to look at regional cities. I was just literally reading an article that came out this morning about the French are trying to repurpose La Défense. It's got I think it's a 15% vacancy rate. Office buildings are looking, with their big trading floors, are just not looking necessarily fit for purpose. And they're talking about introducing residential and student accommodation into these offices. So there's going to be a lot of people talking about repositioning assets, much in the same way as they talked about repositioning shopping malls. And we know where that led. The problem with repositioning, it's a wonderful word. It just doesn't necessarily convey that we're going to make any money doing it. My job is to allocate capital to where it will be treated best. And for me, the certainty of being treated best is to follow what consumer behavior is doing and trying to get in there before everyone else does.
And I guess one of the things that accelerates that is the refinancing of debt as debt matures over the next few years in that space, and having to do that at much higher levels.
I wouldn't worry about I don't worry about doing it at higher levels. I think a lot of offices aren't going to get any debt. I mean, there's various articles. There was an interesting article last Wednesday in the FT about a number one poultry, which is a office building in the city. I didn't get any debt. I don't think I'm not even sure. There would obviously be a cost, because there always is, but I think you're going to be double digits.
Yeah,
you can't be invested. I genuinely mean this. You cannot be invested as a long-term owner. That I think there are companies like Great Portland and Helical and do a wonderful job in repurposing offices, buy low, tired, outdated, and bring them back into economic life. And I think that they are incredibly talented management teams for doing that. But you can't have a long-term relationship with an office building because it just disappoints you. The highlight you have in owning an office building is the day it's finished.
Well, let's turn to the more structurally supported areas, the more positive areas, and where the portfolio is exposed. And logistics and distribution assets remain a primary focus of LondonMetric. And it was clear the attractions of that went through the pandemic so successfully, really. But you can talk us through some of the kind of key attractions of this sector as we sit here today in the UK?
No, I still think it's a wonderful sector. I'll be honest with you. I don't go around one of my buildings and go, what a beautiful building we've created here. Let's be clear. But I think the economics of it are just phenomenal. They're very simple buildings. The way in which the UK consumer is behaving, we need better, more efficient warehouses in order to satisfy growing consumer demands. I think that we're going to see, certainly where we are, where we've been with interest rates and cost of development financing, I think you're going to see shortage of supply so within the next 12, 18 months. And our pivot has been more into the urban locations where land is even more scarce, where there is zero supply. But I'm reminded, and again, this is not a sector that I was born into, it's a sector I've evolved into. But I'm reminded of an interview that Jeff Bezos gave. And he said to the interviewer, there's two things you can be absolutely certain about. Is that one, my customer is not going to ring me up and say, Jeff, would you deliver my parcels more slowly? And two, they're not going to ring me up and say, Jeff, I wish you'd charge me more for my parcel deliveries. So when you think about that, these businesses need to keep evolving. They need more efficient, better located warehouses in order to satisfy both of those growing requirements. The UK consumer is demanding. We are a world class. If internet shopping was an Olympic sport, we'd be on the podium after every race. We are world class, and it gets better and better. Look, I'm amazed. I'll be honest with you. Last Sunday, I was leaving my mother's house in Wales. My wife ordered some printed Christmas cards and a vinyl LP for my daughter for Christmas. And that was 8:00 in the morning. They were delivered to us by 8:00 in the evening. I'm talking printed Christmas cards, not just Christmas card. So warehousing, I think, is structurally supported, to use your phrase. I think we've got a supply limit, and I think we've got a growing demand. So we're going to get rich. And that's the great thing about holding long. Again, to quote Charlie Munger, it's not the buying and the selling. The big money's made in the waiting. It's the time you spend in the market rather than trying to time the market. And it's probably the same in the stock market. We want to buy a wonderful asset for a fair price rather than a fair asset at a wonderful price. Cheap is not a strategy.
And that feeds through into the kind of overall statistics of the portfolio in terms of vacancy rates, long leases, and crucially, the rental growth. We talked a bit about the kind of where you're not invested and where you are. If we turn to the kind of company itself, kind of how you place, given we are in a backdrop of higher rates now, higher financing costs. Can you kind of maybe talk us through the kind of debt profile of the company and the prospects overall on that kind of all-important kind of rental income growth for the portfolio? What are the prospects there?
Look, one of the things I've got to say to you, look, this is an internally managed company, okay, with an ownership culture. Gordon, you and I have known each other quite a long time now. I've never sold a share in LondonMetric, right? So you know what? I have everything on bet on this one. Okay. And the great thing with that is it just avoids you doing dumb things, right? Because you're playing with your own money. And if you do dumb things, you've got to go home and explain it to your wife and your children. So you're better off avoiding that. And that's very different to externally managed companies. I don't think you should be invested in any externally managed funds. I think that the alignment of interest is broken. And I'm seeing it. By the way, I'm sure you're going to ask me about it in a minute, but it's throwing up opportunities. But I think you should steer away from them. That doesn't make them all bad, but I think you need a risk premium if you're dealing with externally managed companies. And you just have to pick up the paper this morning, and there's a big article in the Times around a company called Home REIT. I don't know the ins and outs of it all. It just looks like a train crash. And actually, people went in thinking that this was a good idea, and they've just been deceived, I'm afraid. And you don't get those levels of deception with owner driver vehicles like ours. Debt is something we think about all the time. It's not our job to guess interest rates. It's basically effectively to take the risks out of movements. We have a wonderful debt book today. I'll be honest with you. We've worked hard over the last 15 months to get it in this position. We have an LTV of 29.5%. We're 99.5% hedged. And we've done that, been very alert to it. We have to be ahead of the curve on rates, and we started that hedging process at the end of last summer, really. And also we've sold a lot of assets, which have allowed us to repay floating rate debt. Ironically, we've been selling assets at a yield that's been lower than our floating rate debt, which actually has meant that our earnings, it's been accretive. to sell an asset. Um, and that hasn't been the case generally for the last few years when we've had very low interest rates. So actually our cost of debt fell over the last year. Our cost of debt today it's fully fixed or fully hedged. It's 3.3%. And we haven't got any material refis coming, I don't think, for another 3.5, 4 years maybe. But and we can deal with that. I like my sleep. I like to sleep at night. I like to sleep like a baby. I do not want to worry about refinance. The problem with the property sector generally is that their answer to refinancing is more debt with somebody else. My answer to refinancing is a combination of debt and equity. And that means that's why you see us being much more proactive and on selling assets. I'm sure you questioned me in the past as to why did you sell that, Andrew, when you're trying to build a portfolio. I want to sleep at night. I want a margin of safety. Benjamin Graham taught us that. And so, look, I think that the debt side, you can't get complacent, but we're in pretty good shape, okay? And then on the income side, to your question around growth and stuff, it's wonderful. It's truly wonderful. The highlights of my job when I interact with the team is, and asset management in particular, is talking to my guy. I'm looking at him now. My rent review on he does all my rent reviews on my warehouses, and he gave me a sheet of paper yesterday on some rent reviews that he's negotiating at the moment. And in Cranley, on a 5-yearly basis, we're looking at a 58% increase. In Stoke, we're going to get a 36% increase. In Ipswich, 36. For Royal Mail, they're going to pay us another 43, hopefully. In Dudley, 27. Parcelforce, 55. Ocado, 65. Actually, in Leamington Spa, we're only getting 13%. But it's like money's just being helicoptered in. It's great. It's a bit like that old Charlie and Warren comment. It's just send the money to Omaha. And we're just getting cash coming in, and we don't have to pay for it. It just arrives. But it's a wonderful feeling, and we don't have to spend any money to get it. It's one of the joys of being in a winning sector. And the rents are high. Our compound average growth rate on the rent reviews that I'm looking at the moment, in front of me is about 12, in front of me is about just under 7% per annum. It's a lot higher than I would have expected. Don't redo your forecast and tell you and make you promise that I'm going to give you 7% per annum. I'm not. Yeah. But there's nothing like the pain of being in a tough sector like offices and shopping malls for you to appreciate the joy of being in a wonderful sector. Yeah. And income compounding is a very misunderstood formula. Fortunately, I can work it out.
Yeah, thank you for that. You referred to it a little bit before, but LondonMetric, if you look at the kind of the course of its life, we go into all of the kind of deals, but it has been pretty opportunistic with kind of corporate activity, whether it be merger or acquisitions. And there was another kind of recent example of that with the CT Property Trust in the last financial year. And I wondered if you can maybe talk us through some of the key attractions that you're seeing in that deal and the kind of early success that you've had.
Look, I think my job is to allocate capital, as I said before, to where it will be treated. And we can buy buildings. We're very choosy because we only want to buy buildings that are going to enhance the quality of our portfolio. Okay, we're not into buying cheap buildings. Because the problem with cheap buildings, you just don't want to own them for very long. Then we can look at development fundings for people who are finding it difficult to get hold of bank debt. And that's an interesting place for us today as well, but it's difficult to scale it. And then the third thing is corporate activity. I think there is a sector of the REITs market, externally managed businesses that are unloved or haven't been run maybe with the same efficiencies and the same laser focus approach that you get from an owner-occupier, effectively like ourselves, or owner-driver, sorry. And a number of these companies, CT in particular, their share price, because of their size, suffers from illiquidity. The shares trade by appointment only, as I often say. The manager is the only thing the manager is interested in is collecting his fee. The chair is only really generally interested in collecting their fees, as indeed are the non-execs, and the shareholders are a distant fourth in the pecking order. That's my view of external management. CT was a difference to that. We found an incredibly enlightened chairwoman, I think served her shareholders brilliantly, and an incredibly enlightened board of non-execs, for which we were able to do a deal. And we were trading at a discount of maybe 10%, and they were trading at a discount of 40%. So we were able to give their shareholders a premium, but not still managing to get a discount to their NAV. Now, with all of these corporates, there's always the winners and there's always the losers in the asset. And I obsess about the losers. Selling out of offices and high street retail is obviously a requirement or priority for us. And I think we've done that very well. CT came with a great debt book. It came with low leverage. It actually came with cash on the balance sheet. We've sold probably half of our non-core assets already. So we issued paper at NAV, and we've had about 50 or actually a bit more than that now. We've probably had about 60 million of cash back. So it's been incredibly helpful for us. The challenge is it's set quite a high bar, and then people like you keep asking me where my next one is, and I've got to go off and find another one. It also makes it more difficult when I say that it's been an incredible success, because then the problem is then I try and approach the chairs of all of these externally managed, and most of them won't take my call. They tell me to go away, and I offer them coffee or I offer them lunch, and they say they don't want to talk to me. But look, turkeys don't vote for Christmas, unfortunately. But we'll plug away, and we've confirmed recent press speculation on another vehicle that we're looking at, which is a bit different, but has a number of opportunities that we think are available. And we are being opportunistic on this. Okay, I can't talk too much about it, I'm afraid, because of rules. But we're being opportunistic.
Understood. Thank you. Our kind of standard final question is one where we ask an interviewee, kind of where's your kind of highest conviction area at the moment? I'm not going to ask you to choose your favorite property, but I just wonder whether there is a kind of an area. I know urban logistics is one which you're seeing very strong rental growth in. Is there one particular area that you single out as being particularly high conviction at the moment?
Yeah, look, I think urban and regional warehousing at the moment would be probably my strongest conviction call. We bought a warehouse the other day off BlackRock. It's in the press. You'd have read about it. It's 13 years on a lease let to Next. And it's an important warehouse for Next. It's in Doncaster, which is an important hub for Next. And we paid an initial yield of 6.25, rising to 7.1 over the next 3 years. Now, it's just a wonderful transaction for us. Without being too flippant about it, I probably will never have to visit it, which is always a good thing. And if we were to put debt on that today on a 5-year term, we're probably going to be putting debt in at about 5.1, call it 5.2. So I'm immediately making 100 basis point spread, and I'm going to move to probably near a 200 basis point spread. With 10 years to go, let to a wonderful company. It's very difficult to get it wrong. So I like that. It's low energy. I joke that my teenage daughter could run that business, that part of our business, which you can imagine goes well down with some of my colleagues, because I think it's just a wonderful compounding equation. And I think that Next, with their total platform and the more brands they're bringing onto their website, they're going to be in there a long time. And so we like that. If you wanted an outsider for me at the moment, I do believe in UK staycation. I think it's an interesting structural change. And therefore, I think that has some implications to certain assets. I like roadside assets, destination, leisure assets are interesting if you've got the right credit. Drive-throughs, electric vehicles have an impact on consumer behavior. I sit on the board of the UK's largest charger of electric vehicles, and I have data around consumer behavior as to how you behave with an electric car versus a combustion engine. And that again, I think is interesting. And we've got some money invested in that space as well. And I could see the staycation strategy is something I'm interested in. It's not as easy a conviction to have as the warehousing, but I like it. Yeah,
they're really interesting thoughts. And Andrew, thank you as always for your time. I really appreciate you talking to us today. Thank you.
You're very welcome. Have a good day.
Thank you for listening to the Investor Insights podcast. You can contact info@killik.com, referencing the podcast for more information on any of the topics discussed, or for further details on the services offered by Killik Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. Some of the views expressed by our guest speakers may not be representative of our own views. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killik Co is authorised and regulated by the Financial Conduct Authority, the FCA.